Hello and welcome to Lesson 27. I'm Professor Matt with the Fundamental Investing Institute. Before we dive into the numbers, why do these ratios matter? Credit ratios reveal whether a business can service its debts while continuing to operate effectively. They are the primary tools used by lenders to assess risk, investors to gauge stability, and managers to ensure resilience. In this lesson, we're going to explore credit ratios. These are a core set of financial metrics that help us evaluate a company's ability to meet its debt obligations and remain financially stable. As we'll see, they fall into three major categories, each answering a different question about a firm's financial strength. Credit ratios fall into three major categories: liquidity, solvency, and coverage. Each one answers a different question about a firm's financial strength. Let's start with liquidity. Liquidity ratios measure a company's ability to meet short-term obligations using assets that can quickly be converted into cash. They focus on the relationship between current assets and current liabilities. The current ratio is the broadest measure, comparing all current assets to liabilities. The quick ratio is more focused, removing less liquid items like inventory to see what's readily available to pay bills. Finally, the cash ratio is the most conservative, asking, if we had to pay everything today, how much could we cover using only cash? Next, we have solvency ratios. Unlike liquidity, these assess a company's ability to meet long-term obligations. They give us insight into a firm's long-term financial stability by looking at total assets and liabilities. Key metrics here include debt to assets, which measures the proportion of assets financed by debt. We also look at debt to tangible assets to exclude intangibles, like goodwill, for a clearer picture of physical asset value. And the leverage ratio tells us how many dollars of assets the company controls for each dollar of equity. Finally, we look at coverage ratios. These evaluate whether a company generates enough earnings or cash flow from operations to service its debt. We shift our focus from the balance sheet to the income statement. Important ratios here include operating profit to interest, which measures if earnings can cover interest payments, and operating profit to debt service, which shows if the company can meet all required debt payments from current operations. To wrap up, remember the three pillars. Liquidity ratios reveal short-term strength, solvency ratios show long-term stability, and coverage ratios demonstrate whether ongoing operations can support debt obligations. Together, they provide a powerful lens into a company's financial health. Credit ratios are a powerful lens into financial health. Together, they help us assess risk and resilience. See you then.